Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. As it continues its pivot towards making asset and wealth management a bigger priority, Goldman Sachs is buying Innovator Capital Management, a provider of defined outcome type ETFs, for roughly $2 billion. So joining me now is Bryon Lake, the co-head of third-party wealth over at Goldman Sachs Asset Management, alongside Nick Ryder, the chief investment officer over at Kathmere Capital Management. Gentlemen, thank you both for being with us here in studio for ETF Edge.
Great to be here.
All right, so let's talk a little bit first about this big deal. It's only about a week since it's been announced, but it's been possibly years in the making given some of the trends that we've seen in the actively managed ETF market, Bryon. So why Goldman Sachs Asset Management and why Innovator Capital Management, and why is it a good tie-up?
Yeah, well, you talked about it. Goldman Sachs is really committed to our asset and wealth management business. Our asset management business in particular, $3.5 trillion asset manager. We're the 8th largest asset manager in the world. We're top 5 public active. We're top 6 in private alternatives. But as we think about the major trends that our clients are talking to us about, it's in the active ETF space. And so we have this leadership position in public active, but we know we need to deliver more to them in that way. And so we've got our active ETF business that we've been building for years now. We're really proud of that business. We're going to continue to invest in that. But to accelerate us down that path, we did this deal with Innovator. We've loved that business for years. We've known the founders. We've known the team. We're really excited about this space that they've invented, the defined outcome space. And so when you brought all those pieces together, it really just made a ton of sense.
How much of this story for Goldman Sachs GSAM, Goldman Sachs Asset Management, going after Innovator, is driven straight up by the demand for these types of products? We've been talking about buffer ETFs, defined outcome ETFs for some time, but this seems to me like a very big bet on the future of these types of instruments. So what exactly is the maybe main driver, if you will, for what happens?
So if you think of the identity of Goldman Sachs Asset Management, we focus on the really kind of sophisticated area of the markets and solving those problems for investors. So whether that's direct indexing, whether that's evergreen alternatives, or whether that's active ETFs, that all kind of lives in the same neighborhood for us. And so we think the entire active ETF space is interesting, but defined outcome in particular is a very fast and attractive space to us. It's solving particular problems for investors. They're looking for income, they're looking for downside protection, they're looking for further growth, and it's kind of on this critical path of innovation that's happening in the marketplace right now, where more and more investors are using defined outcome ETFs in their portfolios. And so it was incredibly complementary to our identity as an asset manager, and it was also at this really exciting point of the growth curve of defined outcome ETFs, which we think could 4 to 5x over the next 5 years.
This is a big deal for sure. From an independent, investment advisor's perspective, Nick, when you take a look at some of the products that are out there from ETFs and how they've evolved, these defined outcomes are basically something that maybe more advisors are starting to look more closely at right now. Are you one of those types of advisors? And just how much do your clients on the high net worth or ultra high net worth side of things want to use these types of products as opposed to other wealth management strategies that have been in place for decades at this point?
Yeah, for instance, these have, as you mentioned, existed for quite some time, whether it be in the structured product arena, whether it be in option overlays within investment portfolios. We think there's both a client demand for these. We also see a role for them in portfolios. The way we kind of categorize many of these, and for us, it's really coming at the angle from equity exposure with downside protection built in is oftentimes how we're thinking about these. And we fit these more in what we call a risk-aware growth bucket, where it's enabling our clients to have access to public equity markets, but with some measure of systematic downside protection built in.
How much, Nick, from your perspective, do you think about using these types of products in the ETF wrapper? Cookie cutter is not the right way to look at it, but it becomes packaged, right? You have a product that you can buy right off the shelf, and it does the things that you want to do, as opposed to having a separately managed account for a client that then you actively put options overlays or hedging type strategies in place to enhance or try to get the same kind of outcome. Which is the more desirable outcome for you?
It'll depend client by client, situation by situation, as do many things in investment and portfolio management. We look at the cost side as a consideration, and there's the operational ease. Obviously, the ETF vehicle, the operational ease side is infinite there in terms of being able to have same holding, same portfolio construction across a multitude of clients and manage that scalably. On the cost side, right, as competition is intensified in this space, right, the costs are very much reasonable, and oftentimes what we see is in line with what you're looking at within the SMA space. And so, generally speaking, we have plenty of clients where we do option overlays on top of separately managed accounts. We also have model portfolios constructed of ETFs, leveraging many of these types of defined outcome strategies, as well as other risk-managed equity strategies.
The interesting part about this, Bryon, because we brought up the fee idea here, it's not that these things just happen willy-nilly. There is a cost to transaction-wise or anything else to putting these kinds of structures together. I think about the type of buffer or defined outcome product that we have today. And it was very much an ETF product today, but that was a structured or some kind of a nuanced product for high net worth or accredited investors just 10, 15, 20 years ago, aka hedge fund-like strategies. Right. So if you look at the costs for a hedge fund type product 20 years ago versus what the ETF cost for a similar type of outcome is today, how exactly do they compare?
Well, there's a big difference, and by the way, you're just thinking about cost as like an expense ratio, but what about convenience, like Nick talked about? What about the intraday liquidity that the ETF wrapper brings? What about the comfort of mind of knowing exactly what you own because of the transparency that's provided? And so when we're talking to investors right now, they're thinking about all of these things holistically, and so of course they're making sure that they're paying a fair price for the vehicle that they're getting exposure to, but they're actually taking in a number of different things in the account. How they're serviced from the asset manager, the performance, the totality of the product offering, the website. All of these different things play into that equation. And what you're seeing, and you're making this point, Dom, is that when you take all those into account, put this into the ETF wrapper, the benefits to investors are immense.
From an RIA's perspective, if you take a look at the way that these products are being used, are you seeing a ramp up on your side of things, not just from your shop in particular, but maybe across the industry from independent RIA's perspective? Are they starting to kind of dabble more, traffic more in these actively managed ETFs that target outcomes?
It's definitely seemed that way, absolutely. On our end, where I can speak obviously most intelligently about, where we've used it a lot is for clients where we're looking for public equity exposure, but there's this desire, whether it come from the client end or from our perspective of saying, we want public equity exposure on the upside, but we want to have some systematic approach to protecting on the downside. And so we look at these defined outcome buffer products sitting right alongside perhaps equities with cover calls or trend following equities where there's a systematic rules-based approach to get you out of the market during those sell-offs. For us, ultimately, we know that over the long haul, one of the biggest determinants of investment success or failure is going to be how an investor behaves. Right? Equities go up and they go down over the long haul. They tend to work their way upwards to the right. But we know as through years of experience, right, the ride is anything but smooth. And so if we're able to build portfolios that our clients can feel comfortable in, have conviction in, and ultimately have that discipline to ride out the market's inevitable downside, all the better. And so for us, this category of these risk-managed equity solutions, we think plays a role in a portfolio. And that's where our adoption has really been driven by.
So it's an interesting point because we talk about the drawdowns, and oftentimes those drawdowns can trigger behavior, whether it is about kind of getting in at the right time or out at the right time. We know that timing the market is one of the toughest things to do for any investor out there. To that point, Bryon, what I'd like to do is talk about one of the larger ETFs in terms of AUM that this product that Innovator is putting out, and that's the BALT, the BALT ETF, which is basically an S&P 500 tracking instrument that puts those kind of buffers in place to limit upside and downside at the same time. If you look at the one-year chart, it's pretty telling, right? That one-year chart goes back and shows the kind of tariff tantrum in the markets from April. If you look at the way that the market spiked lower, and you look at the BALT ETF versus the general S&P 500, you can kind of see that blue line on the screen there is the BALT ETF, the one that kind of caps exposure up or down, right? To some of those moves. Exactly. Meanwhile, the orange line there is the S&P 500 ETF that everyone knows, right? The spider. What exactly is the benefit, right? Why would somebody want that blue line on the screen as opposed to the orange line, even though they know that the orange line over the past year has more than doubled the return of the blue line BALT ETF?
Yeah. I think Nick made the perfect point, and he's expert at talking about this as well, but investor behavior sometimes drives your performance much more than the point-to-point on January 1st to whatever we are today, December December 8th. If you weren't invested going into this, you didn't get that exposure, and so there's a lot of cash on the sidelines right now. And so if I'm a investor or a financial advisor talking to clients and I'm saying, hey, I know markets are close to all-time highs, here are the types of tools that we can start to use to get you equity market exposure. That's a really important thing to my practice and to investors to get their long-term returns that they should be getting from equities. At the same time, the market does that, the tariff tantrum that we kind of talked about. If you sell at that moment, you panic, and when do you get back in? Are you getting back in a month later, 2 months later, or are you still waiting for that opportunity to get back in? And so the complementary nature of both of those things. The best portfolios are using all of these tools to design the perfect outcome for what investors are trying to achieve. And so, I think these charts tell a heck of a story there of this is a way to smooth out your ride over the long haul and not try to time the markets, but make sure that you're in the market to participate.
How much, Nick, we look at those two charts, how much is the kind of, I guess, appropriateness for a risk tolerance level in that conversation with you and your clients? Meaning, if somebody is, say, 30 to 40 years old and maybe is okay with the orange line profile volatility and return, as opposed to, say, somebody who's 50 to 60 years old,
yep,
who maybe still wants that kind of exposure, but is not willing to tolerate the more extreme downside risk. So demographically speaking, it might make sense, but just how much are advisors using it in that context, and how are they marketing that to their clients?
Yeah, I think it's absolutely that. And demographics, the age of the investor can play a role, right? We also look at just the individual's, ability, and that'll be ability to take risks, their willingness to take risks, right? Their psychological disposition, and how comfortable are they seeing their portfolio move up and down, right? We do fully believe and recognize that over the long haul, straight, low cost, plain vanilla, passive exposure to the market, highly likely to deliver a superior return over 10, 15 years relative to one where we are building in structural downside protection. That said, not everybody can live from A to Z. What's most important is that we get them from A to Z. These types of products certainly play a role in there, and the age can be a factor of it. It's just also that willingness to take the risk and deal with the ups and downs. And there's many ways we try to go about trying to assess that. Because also, too, right, an investor's assessment of their risk tolerance today may look very different than it did in March of 2009 or of April of this year. Everybody can say after the market's been rallying strongly for a number of years, of course I'm comfortable taking risk. But we know that it's ultimately those stressful moments when the true investor's risk tolerance shines, and that's where we need to understand and make sure we've built a thoughtfully structured portfolio that can ultimately enable the client to get to the long term.
There's no doubt the ETF market has become much more sophisticated with just the product offerings that are out there. So that there are tools, in essence, to do all of these things. Bryon, the other thing that you mentioned before that I want to hit on here is we talk about these defined outcome type products, these actively managed ETFs as a bigger umbrella. Mm-hmm. But buffers are not the only thing that are part of that kind of suite of products. There are other types of instruments that use similar strategies to obtain certain targeted outcomes. I can think of income being one of those ones we talk about quite a bit right now. What exactly does the Innovator deal, and what exactly is GSAM's overall take on just how much these tools will matter in the coming years and decades to service some of those needs?
Yeah, I think of like the S&P 500 is kind of like an acoustic guitar, and then you can plug it into an amp, or you get an electric guitar and you can make all these different noises out of it, but you still have this kind of reference instrument with that. And so the defined outcome space is kind of that space. So, we talked about income-oriented strategies. The covered call category has grown rapidly over the last decade, and investors are continuing to look for income in their portfolios. And so we certainly see that playing out. Goldman has some leading capabilities on the active premium income side, and so we're participating in that. We've talked about the target buffer thing. We were talking about BALT a second ago. Some advisors talk about bonds in their portfolio as even though you might be a little bit younger profile, you still need to eat your vegetables. And we're actually seeing BALT be used as a bond alternative, BALT. And they're taking that and using it as bonds instead of kind of the core equity exposure as well. And so there's this like third dimension of portfolio construction that's starting to happen with these tools that are happening. And then the third area is kind of these growth areas. And you can get accelerated returns from this. We're seeing dual directionals start to play an interesting way, in auto callables as well, which can circle us back around into the income side of things. And so the whole kind of space is you've got this reference asset, and then now using options, relatively straightforward strategies that have been used in portfolios for years now, But the innovation being putting it into an exchange-traded fund and listing it on an exchange is now giving investors all these different dimensions that they can deliver these outcomes for their investors and for their own portfolios.
Bryon, how sophisticated does a user of these tools need to be? Because in essence, what you're talking about are products or strategies that have been reserved for very, I guess, sophisticated investors in the past, but are now very democracy-wise accessible to vast portions of the investor population based upon the use of the ETF wrapper. Just what does an investor or trader need to know about these types of products so that they ultimately do the job that they are supposed to, given the risk-reward profile of each of those instruments?
Yeah, investor education is something that we are completely laser-focused on. If you look at the Innovator website, the tools that they provide for investors to make informed decisions around these are extremely sophisticated, and they're very intuitive and easy to use. We, of course, when we're talking to individuals, talk to your financial advisors, make sure that you're getting financial advice from those individuals. That's not what we're kind of in the business of doing. But what we are seeing is that as investors start to use these tools, they understand how they move, and they're starting to be able to incorporate them into portfolios in that way. So education is always the first thing. When ETFs first came out 30 years ago, that was a big part of it. When fixed income ETFs first came out, 20 years ago, that was a big part of it. Making sure that people understood how these products were going to work and to incorporate them into their portfolio is always kind of paramount. One of the benefits of the ETF is it's on exchange and it's transparent. You can jump on the website and see exactly what you own within your portfolio real time today. And so the ability to educate yourself, understand what you're getting in the portfolio is extremely high. But of course, we encourage people to make sure that they understand what they're buying. That's true for every investment.
Sure. And to kind of cap the conversation off, if we talk, Nick, about just the level of investor sophistication, many of the clients that you service and other RIA service are relatively smart in terms of how they manage their money. They wouldn't be as successful as they are unless they did. But to what degree has that knowledge curve evolved for your clients, say at Kathmere, over time? Are they becoming more sophisticated as the decades kind of go by? Or do you feel as though there is still a general sense of, I guess, maybe a gap in information for how even high net worth investors view some of their instruments?
Yeah, I think as many things, it runs the gamut. We have clients that are very investment sophisticated, right? They enjoy staying up to date on these things, doing the reading, doing the research, engaging me and my team on these conversations, and very much like playing a role in the management of their portfolio. And the information availability in the world today, obviously, unprecedented relative to 5 years ago, 10 years ago. And so clients are able to do that. We also have other clients that have been very successful in their professional lives, and they say, look, my expertise is in running my business and building my company, generating wealth. I trust you, Nick, and your team to manage my wealth for me. And so it runs the gamut. Again, Innovator puts a lot of effort into, obviously, the investor education that comes through on our end and being able to see how these strategies are performing, understand the upside, the downside scenarios of these. With many of portfolio construction, we ultimately look for that clear line of sight. At all times with all assets, we want to have a great understanding of what role is it playing in our client's portfolio? How can we expect it to perform in good times? How can we expect it to perform in bad times? That gives us clear line of sight when we ultimately try to build out a diversified portfolio.
All right, one final question to you, Bryon. Goldman Sachs Asset Management, as you point out, very large footprint in terms of asset management on the ETF side of things and everything else. Just what kind of commitment will Goldman be looking to make in the coming years towards the ETF space, specifically when it comes to active?
Yeah, I think we've made a pretty big commitment right now, and we're just going to continue to execute it down that roadmap. I mean, we've talked about the Innovator strategy. That also comes with 70 people from the Innovator team that we're thrilled to have. They bring a tremendous amount of ETF DNA to the equation and a great level of sophistication, combined with the existing Goldman Sachs team, which is a really powerful, thoughtful, and well-educated team as well. We think that we've positioned ourselves really well to serve clients going forward, and we're excited about our ETF strategy.
All right. My thanks to both of you, Bryon and to Nick as well. Thanks for joining us here on ETF Edge. We've actually asked Nick to stick around for the ETF Edge podcast. You can catch that and all of our other content over at etfedge.cnbc.com. Thanks for watching. We'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.